Let's talk a little bit about volatility. Volatility is something I think that can be overutilized and underutilized. What do I mean by that? You hear people talking about volatility all the time. The VIX in itself used to be a measurement of the options on the S&P 100. It has kind of evolved over the time, and I can't even tell you exactly how it's derived anymore. So, therefore, as indices change, as the VIX has, it becomes a little bit different and difficult to analyze, much like tick information and much like prices in the S&P, since they're always discarding the old names that flame out in the S&P and bring in new names. It's got a upward bias always. So these things really are important to understand how they function. One thing that I believe that we're seeing as it relates to volatility right now is volatility is becoming more and more volatile, even though we've been in a range here most of 2013 where volatility, the index itself, has been less so of a number and kind of hanging around that 12 or 13 area for good chunks of the time. But then we get these very powerful spikes up to the early 20s for instance, and then 2 days later we're right back into the 12s. So understanding the context of volatility is as important as the number, and I think because we have so much intervention between QE over the last 4 years, and we have so much FOMC chatter, almost let's say a dozen times a week we have different Fed heads talking to us. We've got jobless numbers, we've got a litany, and we've talked about this, we've got a litany of economic indicators and jobless claims, GDP, CPI, PPI. The more that the government tries to intervene with free markets, I think what you're starting to see is more and more people, more big money, leave the market. And what that tends to, or where we're kind of heading right now, is we're in a period where we get these great swings in intra-day, week, month volatility, yet the number stays relatively low. And why is this important? Well, it's important to note because in environments like this, it makes it very difficult for very short-term traders to trade with size. So if you're out there trying to scalp in a volatility environment like we're in, I'm in a state of mind right now where you have to be short complacency and long volatility. So what do I mean by that? We're in a state of market right now that I think people have been very comfortable with buying the dips. There aren't really dips per se to buy that I would buy as a trader, but it seems to me that the small short-term money is buying any little pullback that they get, and that's been the case all year because of the winds behind us from QE. Now, everybody, I think, is under the impression that rather not impression, but they keep talking about taper, and I don't think a taper is going to come. I think it's already well into the cards that the Fed and the money policies and the fiscal policy, the monetary and fiscal policies are such that they've painted themselves into a hole. They cannot stop printing money. The dilemma they have, and the bond markets are already telling you this, is that we're starting to tick up in interest rates. And part of the problem is that the debt that is compounding for the U.S. government is so out of control now that the Fed is now demanding Congress and Senate tax as much as they can, anywhere they can, however they can. And that's why you're seeing so many laws change worldwide into transactions that are happening across borders, because every country is in the same situation. So this printing of money is starting to come to root, and I think if you're long complacency and short volatility, the opposite of where we are, I think you really need to check yourself, because I think we're in a period now, especially 2014, 15, 16 through 20, that volatility is going to continue to explode, and you're going to see longer periods of time between highs and lows versus the shorter periods where we've kind of coming off a bottom possibly right now in overall long-term volatility, and these are just the first percolations. So I'm long complacency or rather short complacency and long volatility here over the next few years. Are you ready for that type of change in your trading? I can tell you that Market Profile and the Market Profile Trading Academy are tools that will help you with this. Please join us here at Mistrade Member. Check out our Twitter feed option and our one-on-one education and our seminars with groups at the mistrade.info website. And please understand the context of the market that you're always in and maybe where we're transitioning. Nothing goes up forever and nothing goes down forever. The transitional periods are very important, and the nuance to understand those are quite important. So please check yourself. Again, we are short complacency, long volatility at mistrade.info for the next few years. Hope to see you and hope that you join us here at the Market Profile Trading Academy.